Hey folks, it's Rob Flux here from Property Developer Network, coming to you for yet another one of our Sunday sessions. This week, our topic is the 7 rules of thumb that every property developer should know. These are some of my own personal rules of thumb. They come directly from my Property Development Formula program. And I guess I'm going to share them with you guys today so that you guys can hopefully get on the right track. Now, I run these Sunday sessions every single Sunday at 5 o'clock Brisbane time. So if you haven't yet already, please make sure you like our Facebook page and you will get those alerts every single time. So let's take a look at these 7 rules of thumb, shall we? So if I just go through them very quickly at a very high level. So I'm going to go through the 3 different elements that you need to know as to what to do in your deal. We're also going to have a look at the different ways to measure profit. We're going to look at how and where to farm for your particular developments. And we're going to look at what activity creating results and how to actually ensure that you're actually going to get the results they're actually after. Then we're going to go through finance rules of 3. So how can we actually go about funding these projects? Then a little bit further, we're going to look at what is real wealth? How do we measure real wealth? And how do we look at the ever elusive financial freedom name that everybody refers to, but nobody's really got a targeted definition. So we're going to have a look at that for you. And lastly, we're going to teach you how to keep your profits, which is the way that you're actually going to achieve that financial freedom. So there are our 7 rules of thumb. We're going to go through them in a fair bit of detail. After that, then I will go and take some questions from the audience. Now, let's have a look at rule number 1, shall we? So the 3 elements of a deal. Now, this is one where I think a lot of people get really confused with regards to what is actually part of a deal, and they get sold all this hype about different acquisition strategies and options contracts and all sorts of things like that, as that is development. But the reality is that the first part to your deal is the actual development strategy itself. And this is the skills that you need to learn. So whether you are going to learn subdivisions, whether you're going to learn townhouses or rent per room or rooming accommodation or renovations, they're the development skills that you're actually going to learn. And when you determine what your development strategy is, then you can actually find the appropriate educator to teach you those particular skills and go on a fast track to specialize in that. Now, once you have the development skills, that's only a small portion of the process, because being able to identify a site that is developable and profitable is great, but comes down to then what is your financial circumstances and your ability to actually acquire the deal. So acquisition of the deal, this is tactical, okay? So tactical, every single time you come into a deal, chances are your financial circumstance is going to be different. So for example, you may be cashed up today and you go and buy this deal and then tomorrow another deal comes along. You've just spent your money on the last deal. So you have to be quite creative in your acquisition strategies, right? So when you understand the difference between acquisition and development, a lot of people get those two confused and think when I ask what is your development strategy, they tell me I need to do a JV. No, that's an acquisition strategy. Your development strategy is I'm going to do a subdivision, or I'm going to do a townhouse, or I'm going to do a renovation. And your acquisition strategy is just how you actually come across the deal. Now, once you've acquired the deal and then you're actually running the deal, the next thing that you want to look at is, well, the last part of this process, which is how do I exit the deal? And this is strategic. So tactical to acquire, because that is right here, right now, and what am I actually doing? But exit strategy is strategic. You want to actually understand what your exit strategy is before you acquire the deal. You want to understand what your cash flow requirements are, your capacities to actually run the deal. Is this a deal you want to keep long-term? Are you going to sell everything? Are you going to sell some things? You should be quite strategic in that right up front, because that determines the entity that you created in, it determines your taxable outcomes at the end, all those sorts of things. So whenever you are going to go into a deal, you really need to understand all 3 of these elements. So please, please, please don't get those confused. Once again, development strategy is the skills that you need to learn. That is, I guess, the educator you're going to go and choose to learn those particular skills. And there are thousands of great educators out there. Myself is one of them, that will specialize in very specific development strategies. So understand what your development strategy is and focus on it. Get very, very clear. Then your acquisition strategy, that's how you're going to tactically acquire that deal. And your exit strategy is how you're going to strategically exit. So that's rule number one, folks. Rule number two, the different ways to actually measure profit. This is one that sometimes just drives me balmy, because when you ask somebody a question, well, how much profit do you aim for in a deal? Invariably, the answer that comes back is completely different for most of the people that you actually talk to. And the reason is because there are many, many ways to measure profit. And so my job to you is to actually get you to ask a smarter question. So if you can ask better questions, you're going to get a better answer. And if you get a better answer, then you can actually compare the different levels of profit in a deal. So I'm going to actually go through this in detail. I've got a very specific example that I'm actually going to walk you through and show you how the exact same figures in the same deal can give you very, very drastically different percentage returns when measured in many different ways. So let's have a look at this. So the first way to measure profit is what is called profit on gross realized value, or GRV. It's also sometimes known as the development margin, depending upon, I guess, what part of the country you're actually in. How it's actually calculated is it's your project profits divided by your gross realized value. And your gross realized value is the sale of the finished product. So if you're selling 10 widgets, then what is the revenue from 10 widgets? What did it cost to construct those widgets? And then it's that construction cost divided by the gross realized value. So that's what percentage profit on GRV is. The next way to measure profit, okay, is called percentage profit on costs. So slightly different here. So sorry, I should say bit of a typo, I should say, in that last one. Not a typo, bit of a word slur. I jumped ahead of myself. It's project profits rather than total development costs on the previous one. So this one is percentage profit on costs. So apologies for getting ahead of myself there, folks. So this is project profits divided by total development cost. Previous one was project profits divided by gross realized value. So percentage profit on cost gives you a very, very different number. Now, when you're talking to financiers, the majority of them will be talking about percentage profit on costs, but not all of them. Majority of them will be talking percentage profit on costs. Whereas there are going to be some financiers and some individuals that will actually be talking about percentage on GRV, and the numbers, the outcomes of those can be very, very different. Then the next way to measure is percentage cash on cash return. So this is how much cash you've actually put into the deal in order to actually make the profit. So it's project profits, I should say, divided by the cash used in a project. And please note, this does not consider your borrowed funds. This is the actual cash that you actually put in. Now, I'm going to go through a real live example and show you why these different ways of actually measuring profit can be somewhat misleading. We've heard the expression lies, and damn statistics. I am going to prove it to you right here. And then there is my preferred way, which is my secret sauce, because every single one of these gives you a percentage on your cash, but it does not actually consider time. So time is actually a valuable commodity. And when you start to consider time, if you start to annualize the returns and actually understand, well, if my project took 9 months and the other project took 18 months, which one is actually giving you a better return? Only when you annualize those percentages can you actually work that out. And that's how you compare how hard your money is working between different projects. So let's have a look at this in a little bit more example. Let's consider this fictitious project. So our purchase price is $1 million, in which case for this particular project, we've come up with $200,000 cash in order to come up with a deposit. We've got a borrowing of $800,000. Our project running cost is going to be 100,000. Our GRV, gross realized value, is going to be 1.2 million. And our project duration is going to be approximately 6 months. So in this particular instance, we have a profit of $100,000. So that is the GRV, 1.2 million, minus the running costs, minus the purchase price. So that gives us our profit of $100,000. Now that seems really, really simple when we actually look at the cash. But if we then go and have a look at those different percentages, if we look at percentage GRV, so gross realized value in this instance was 1.2. So it was 100,000 divided by 1.2 gives us an 8.3% return. Now, if we look at the percentage profit on costs, again, profit is 100,000, but the costs will be the purchase price of 1 million plus the running cost, which is 1 million, so 1.1. So it's actually 100,000 divided by 1.1 gives us a 9.1% return. Still the same $100,000 cash. And that's the point that I'm trying to make here, is that when you ask the question as to how much profit did you make, one person might tell you 8.3, next person might tell you 9.1. Let's take that a little bit further and say, what is the cash on cash return? In this instance, the cash that went in was the deposit, $200,000, the running cost of 100,000. So it's a total of 300,000. Our profit is 100. So it's 100 divided by 300,000 is 33% return. So again, exactly the same, 100,000 cash. And yet somehow we've gone from an 8.3% return to a 33% return. And so, depending upon who you are and how you actually measure that, that can be quite, different in the result. Now, let's imagine this exact same scenario. And if in the next instance, that deposit, the 200,000 cash, what happens if we actually don't come up with cash? What happens if we happen to have security in another property and the bank has actually allowed us to use that security and allows us to borrow the entire $1 million? Now, in that instance, everything changes massively. So now we've only got $100,000 running costs. So our profit divided by 100,000, it'd be 100% return, 100%, 1,000% return. So it's can be very misleading because the actual cash in is very different. Now, if we have a look at my secret sauce, I start to annualize these because this is a 6-month duration. What we're going to do now is to say, well, all of these are going to be doubled in order to get it to 6 months' time. So the GRV would be 16.6, the profit on cost would be 18.2, and the cash on cash would be 66.6. Now, the reason why I'm using this example is if I now consider this exact same project, but in this time, it actually took 9 months and not 3. Let's start to have a look at the numbers here, okay? So now the percentage profit on GRV has not changed because we have exactly the same profit. We have exactly the same gross realized value. The percentage profit profit on costs is exactly the same because we've got exactly the same profit. We've got exactly the same costs in the project. Our cash on cash return is exactly the same. So when you're comparing these two projects, when you're looking at the pure percentages, which is how the bank looks at it, these two projects look very, very comparable. But in reality, one took 6 months and one took 9 months. So if you use my secret sauce and actually annualize the results, you'll see that in this second project, when we actually annualize that, we get an 11.1% profit on GRV, a 12.1% profit on costs, and a 44% cash on cash return. So clearly, when we compare these two projects, project number one that only took 6 months means our money is actually working harder and working smarter. So one of the things that you need to do is not just look at the raw numbers, but also take into consideration the time consideration of that in order to compare two projects against each other. Now that could, when you're doing one project that takes 9 months, another one that might take 2 years, that's really important to understand that time consideration. So make sure that you are looking at that the whole way. So rule number 3, where are we actually going to farm for our opportunities? Now, I get asked this question all the time. So I'm not going to give you a suburb, okay? I'm not going to give you a series of suburbs, but instead I'm going to give you a methodology where you can actually work that out for yourself. Now, I'm not going to go into a huge amount of detail because that's what we cover in our property development formula program, but I'm going to give you enough of an insight into it that if you apply some brute force into this, you can actually try to work this out for yourself. Now, the reason why where to farm is important is that 90% of all developable sites are not profitable, which means that you could be in an area where you are banging your head up against a wall going, why can I not get a deal to actually stack? Every time I look at something, the numbers just don't work. And that's highly possible because that area might be developable but not profitable. So how do we determine if the area is going to be both developable and profitable? Well, we can't guarantee every single deal in an area will work, but we can certainly improve the chances of it. So let's have a look at that. So in order to improve our chances, what we want to look for is suburbs where the averages are actually working in our favor. So we're going to have a look at the average purchase price. We're going to look at the average development costs. We're going to look at the average sale of the finished product and actually go on balance of probability, given the evidence of other people having gone before us. Can we actually make this deal work? Can we make this suburb work? Okay, so let's look at that in a little bit more detail. If we buy the average house in the suburb, then spend the average costs on the site to develop it, would the sale of the finished product of the average finished product actually be profitable? Or put another way, our potential profit is the finished product sale price times the number of dwellings minus the typical project costs minus our median house for the purchase price. Now, that little formula there is your ticket to gold, my friends. Basically, what that's going to give you is suburbs where, on balance of probability, the majority of deals will actually work. Now, that doesn't mean that other areas won't have deals, okay? There are always going to be opportunities in suburbs where you can buy under market value, where you can get the perfect site that has very low development costs, or you happen to have a fantastic site with great views and you might get an uplift on those. So those deals will actually still happen, but you're going to be banging your head up against a wall 99% of the time and struggling to actually understand why your deals don't work. Whereas if we do this way, we're going to be in an area where we've got high amount of demand and we've also got evidence that other people have been successful before us, which means that there's a high probability that we will also be successful. So make sure that you are looking in areas where those averages are working in your favor. And beware, not all suburbs are profitable, okay? So can be quite tricky to actually work that out and will take some time. Those of you who are interested in our property development formula program, we help our students by giving them some very sophisticated spreadsheets to actually reverse engineer this for them and work out how the suburbs are actually performing. Rule number 4, activity creates results. Now, if you put 300 opportunities into a funnel while you're learning the process, then high probability that only one will pop out. And the reason is that when you're learning the process, you have to go through and learn how the development strategy works. I need to learn all those rules. I need to work out, I guess, all my sale prices. I need to do all my feasibilities. And every single one of those learning opportunities, we're going to make mistakes. And what we're eventually going to do, we're going to jam all these opportunities in from all these different sources. And as we start to have the opportunities bubble in, we're going to start to go, does the site have development capability? We're going to start to rule out a whole bunch of sites. As we start to rule those out, while we're learning, we're going to make mistakes because we haven't done it before. We're still learning the rules. We don't know what council's going to do, all that sort of thing. So it's going to take us some time to learn. Now, the good news is while we're making those mistakes, it's not costing us money. It's just costing us time, okay, as we actually learn. Then when we actually work out has it got development capability, remember I said 90% of development sites aren't profitable, the next thing is we have to work out, well, is this one of those 10? So we might be throwing 90% of those opportunities out because we've proven that they're not profitable. And at this point, we've proven A, it's developable, B, it's profitable. And then last, we then have to start initiating negotiations. And again, we're very new to the process. We're going to start to make mistakes as we stuff up our negotiations with their vendors. We don't know how to deal with our agents correctly. Again, we haven't lost any money at this point. It's all paper-based losses at this point in time. And so when we're very, very new in the process, 300 opportunities come in. Finally, we get to suitable terms, and finally we get one deal out. So 300 in and one out while we're learning. Now, as you become experienced, that 300 changes to about 100. And so that activity creates results rule means that you have to put a bucket load of deals into your funnel. So just keep jamming them in, folks, whether they be door knocking, letterbox drops, talking to agents, talking to buyers agents, talking to your networks of consultants and your friends and your family and all those sorts of things. Every opportunity that you can get, you want to start jamming into that funnel. And ideally, you're trying to jam them in based on the previous rule, knowing that it's in an area that's actually going to work in your favor. So make sure you remember that. Rule number 5, the finance rules of 3. Now, there's actually several rules here. So we're just calling this one rule, but it's the rules of 3. So when we're actually trying to finance our deals, there's a couple of things to remember. So there are 3 key elements in running any deal when it comes to the money that was required. We need equity, which is going to be the deposit that we are actually going to use to purchase the property. We need serviceability, which is the ability to service the loan in order to purchase the property. And then we need liquidity, which is the funds to actually run the deal. So we need 3 finance problems that we need to solve in order to purchase any one property. There are going to be 3 stages that we need to solve those 3 problems. So we'll need to solve that for the initial purchase. We may need to then refinance into a construction stage. We may go from residential at stage 1 into commercial on stage 2. And then if we're going to keep any stock at the end, then we'll refinance any existing stock we're going to keep. So 3 elements for 3 stages. Okay, so rules of 3. The next rule of 3 is 3 dwellings is our magic number. If we've got less than 3 dwellings, then chances are we can actually get residential loans. If it is greater than 3 dwellings, then chances are it's going to have to be a commercial loan. That changes massively the amount of money that we have to, the interest rate that we have to borrow, the amount of equity that we actually need in the deal. And so if you're very new in the process, you may be able to get residential loans as you're kicking this off. But as your deals start to scale in size, more and more likely, you're going to be needing commercial funding in order to get the construction stage of your project underway. The next one, there are 3 lending scenarios. So there's residential loans, there's commercial loans, and there's private loans. So different ways of actually getting the money with different rules actually associated with them. So residential typically has an 80% loan to value ratio and very low interest rates. Commercial loans typically have a 70 or 60% loan to value ratio and much higher interest rates. And private equity loans have some flexibility in what they can actually do. Sometimes they go as low as 80 and sometimes they go as high as 50% loan to value ratio, and the interest rates are ratcheted much higher. So whilst those 3 scenarios actually exist, the reality is that residential loans are going to be, harder to achieve, for development funding, whereas the private loans are going to be a little bit more flexible in what they do. So yes, they're going to be higher in interest rate, but very flexible on the terms in which they offer it. And then the final rule of 3 is that 1/3 of the funds will be needed as equity. As you start to scale your projects and as you start to go into that commercial lending space, then you're going to need about 1/3 of your deal as equity sitting in the deal in order to get the lending for the rest of the deal. So Make sure you always consider those as you go if you want to make sure that you're able to take your project all the way through to construction. So that is rule number 5, is our finance rules of 3. Rule number 6, real wealth. What is real wealth? So this is where we actually define what our financial freedom is. So real wealth actually comes from passive income. As sexy as it is to be a property developer, we effectively have a job. We have to go out and through our sweat equity, we're actually manufacturing our profits, but we actually do have a job. So the ultimate outcome is for us to accumulate enough positively geared income properties that we no longer have to work, okay? So we are not trading stock all the time, but instead we're keeping those passive income. So now in the early days, we need to do the property development in order to start to accelerate our capital growth, but it's actually income generating properties that we want at the tail end. And ideally we want to own them outright wherever humanly possible. So financial freedom is having enough of that passive income to cover your debts, which means if you have, I guess, fuel, food, telephone, kids at the school, all of those sorts of things, those debts are going to keep coming in over and over and over. And if you've got enough passive income coming in to cover those debts, you are technically financially free. And financial freedom then gives you the flexibility of time. You have the choice. Do I want to go to work? Yes or no? Financial freedom is not having this massive mansion, and it's not having this fancy car. It's really just having the choice of time and what do I want to do with it. Now, of course, one of the choices that you might make is, well, I might continue working, build some more passive income, and then get myself a better lifestyle because I really do want that fancy car and I really do want that fancy house. But at the point where you have financial freedom and you have that passive income, you can now choose, do I go on a holiday now? Do I choose, do I go back to work tomorrow? So choice is really the valuable commodity that we're all looking for in this process. So how do we actually get that financial freedom? Well, it's all about keeping our profits. This is rule number 7. Rule number 7, if we can keep our profits, folks, then we have massive advantages, a whole bunch of fronts. So if we don't sell our profits, then we don't actually realize our cash. And if we don't realize our cash, then effectively we are not being taxed on the income it actually generates. It's a way to defer the tax to some future point in time if we ever go to sell the property. But why would you sell the property if it's generating all that passive income? So what we're trying to get to is a point where we can keep a property that doesn't get cashed down, meaning that we get to keep 100% of the profit actually in the deal. And I'll show you how that works in a sec, okay? So if we can defer those profits by not selling, okay, that means 100% of the profits actually stay as equity within the deal. It means that we will have positive cash flow as the rental income from the property. We're also going to have long-term capital growth from keeping the asset. So all sorts of benefits from being able to keep our profit. Okay, it also gives us increased borrowing capacity when we go to do our next project because we've got equity in this one and we've got additional serviceability as well. So let me show you how that works in a sec. Now, how do we keep one? Well, assuming we get 20% profit on cost, which is the magical, mythical number that most people are actually aiming for, 20% profit on cost. Remember, I showed you how to measure that a little bit earlier. That means that if we do a project that is 6 of something, so 6 is your magic number. So if you do 6 townhouses or 6 blocks of land or 6 unit complex, something along those lines, if we sell 5 of those down, then the 6th one is actually going to be kept free and clear. So again, sell 5, that pays down the costs because we've got a 20% profit on cost, and the 6th one is owned free and clear, meaning 100% equity and ownership outright, plus 100% positive cash flow out of that one asset. Now let's have a look at this a little bit more graphically. So in a typical project, when you're selling down all your stock, you've got all this income coming through, but then you have to pay GST on your sales. Chances are you're going to have to pay company tax on the profits that your project actually made. That then gets distributed down to you as the individual. Then you've got income tax, which means that the usable cash that you've got left over is significantly lower than the original cash that you actually earned out of the deal, to the point where in some instances it's about 55% of the profit that you actually made ends up being in your hands, depending upon what tax bracket you're in and how you're structured from a tax perspective. Now let's flip that on its head and say, well, if we can actually do that project where we keep one as profit, let's have a look at how this works. Well, in this particular instance, we're not paying all that tax. Remember, I said it's actually deferred, but instead we have some inaccessible equity. We're going to actually have some equity in the property that we are going to have trapped in there, and then we're going to re-borrow against that because it's actually owned outright. We're going to refinance that through a line of credit or something along those lines, and we can effectively pull more of that cash out and repurpose that cash into the next deal. So one, if we compare these two, how much liquid cash we get, and here, how much liquid cash we can actually pull out. So we actually get access to more cash that we can then put into the next deal. And the benefit of this is this cash is actually now tax deductible. Plus, on top of that, we've got 100% positive cash flow coming in, which allows us to actually service that refinance that we're actually talking about. Now, because we're also keeping the property, that means we can actually keep this for a long period of time. And as we do that with normal market movements, you've heard the stereotypical your property doubles every 7 to 10 years. If we assume that, if we keep it, then what that means is we're going to get the benefit of that long-term capital growth. And as you can see, if we keep it for quite some time, the amount of money that we can actually pull out of that way exceeds the entire 100% that we would have even earned in the original project. So that is our ultimate goal. And then once we've got, so that allows us to start to scale our projects. Once we can scale our projects, if we can keep enough of those assets to pay those debts, then we should then, in theory, be financially free. We pay back all the lines of credit because we no longer need to borrow to do the next project. And now it's just 100% positive cash flow. So there you go, folks. That is our 7 rules of thumb that every property developer should know. I will go and grab some questions from the audience in a moment. But just a reminder, we do these Sunday sessions every Sunday, 5 p.m. Brisbane time. I say every Sunday, I'm going to say it's about 95% of all Sundays. If you would like to follow us, make sure that you follow our Facebook page, facebook.com/Property Developer Network. If you like that, then you will get the alerts every single time we go live. We also have 2 Facebook communities, our Property Developer Network group, where the community will actually help you to push your projects forward, where you get all the alerts on what our events are coming up, that sort of thing. We also have a sister Facebook group called Development Site Deal Hub, and that's a great place where you can find deals, we can flip deals, and you can also find investors. So that said, that's my 7 rules of thumb. What I'm going to do now is I'm just going to very quickly go to Facebook, see if I can find some questions from our community and see, I guess, what everyone's what everyone wants to know about those 7 rules. So give me 2 secs. I've got lots of people saying hi. So hello, everybody. Seeing if I can find some questions. Lots of people just saying hi. So hello. I'm going to say hello, Sean, Laura, Matt, Frank, Tarek, Harry, James, Julie, Krishna, Harry again, Lynn again, Harry. Wow, you guys, they're everywhere. So a lot of developers don't get it. No, that is correct, mate, Harry. 100% on that, mate. So Harry's also saying all you need is 1 or 2 projects to work and you're settled forever. You're close, Harry. I'm going to say that for most people, it's a 3 to 5 year journey and somewhere between 5 and 8 projects. So most of us are going to start from a fairly low base. when we start from that low base, we firstly need to learn the development skills. As we start to learn the development skills, we're then going to collect some cash. We're going to recycle that cash into the next deal, build on those skills, build on the cash until we can actually get to a project that is large enough where it's that rule of 6 that I was talking about, where if you've got the 20% profit on cost, you can sell 5, keep 1. And then it's just a rinse and repeat, and we should be able to do that at that point. So 3 to 5 years and somewhere between 5 and 8 projects is probably what I see typically, mate. So Harry's just repeating a lot of the things I'm saying. Not all suburbs are profitable. Absolutely, mate. There are a ton of them that are not. And Vanessa says, Rob's property development formula is the most amazing hands-on course I've ever done so far. So good I've rejoined for the 2nd year. Thank you, Vanessa. Really appreciate your support, and I guess know that you are well and truly on your journey and a long way into the process. So I cannot wait for the, I guess, the real deal that you will eventually do on that first deal that is going to land any minute for you. I know that for a fact. Harry said, I've just started the course. Thank you, mate. Appreciate that. Haven't actually started for you, Harry, but just around the corner, mate. He's made a comment there about Bankwest. Only bank is Australia. Not quite sure what that's referring to, mate, but there's lots of, there's lots of things with no money down deals and all sorts of things like that we've not yet shown you, Harry. So, mate, finance is one way, but alternative finance models are also another way. So K Wong says, hi Rob, what do you think of beginners to sell the property with permit and not having to worry about the cost and risk of building it? So K Wong, firstly, that is a plausible strategy. And I say plausible because I see a number of development sites with a DA uplift on it that the DA that's been added to it doesn't actually add value to the property. So firstly, sometimes it's the wrong kind of development approval, so it doesn't really suit the demographics of the area. Or alternatively, it's been done in an area that's not going to be profitable. So you need to understand up front, the guy that's going to buy it off you, that is going to do that development in the end, they need to make money. If they don't make money, they won't buy it off you. So you need to actually, in acquiring the site, I talked about exit strategies as the rule. You need to understand how much money is left on the table for the next guy to actually take it off my hands. And if there's not enough money on the table, then they'll never take it. So, make sure that you understand that. If there's money there, then absolutely you could potentially get a DA uplift. But don't assume that just putting the DA on itself is enough. Rajiv says, how does one structure their properties to avoid land tax if all the properties are in one state? So Rajiv, firstly, what we try to do is keep all of the questions in relation to, I guess, the theme of the day. So that's the first thing. That said, more than happy to try and help you here, mate, but not knowing which state you're in, every state has slightly different land tax rules. But as a very generalization, what I would say is that most states have a threshold for the amount of property that you're actually allowed to own in an individual entity name. And when you breach that threshold, then it starts to trigger land tax. So in many instances, you may actually need to own your properties in different entities. Now, which entity and in which state you're in is going to be very subjective. And I can't give you legal advice on that or financial advice just for legal reasons. But what I would say is make sure that you actually talk to your accountant about your particular state and how you may have to actually restructure that where appropriate. Harry says, not selling is the best. Absolutely. You get caught with grouping smart professionals. You will get caught with grouping. Smart professional can help you. Okay, I think Harry is actually trying to answer Rajiv's question from earlier on. So yes, mate, you can actually get caught in some states with grouping your properties together. So absolutely. And Looks like Rajiv and Harry are having a conversation between themselves, so I'll just leave those guys there. More people that have joined us, so Carmel, Dean, and a whole bunch more. JJ saying, Rob, isn't it fair to say that in keeping the asset and extracting value via line of credit or something, you incur servicing costs? Absolutely, you incur servicing costs, JJ. But in the instance that I was actually talking about, you're actually pulling those costs out in order to then go in and do a bigger project. When that project is finished, you can then pay the debt back. And so the servicing cost then becomes, I guess, a cost of the next project. So you're actually paying yourself to fund your next deal, so to speak. So it starts to get exponential as to the kinds of returns that you can actually get once you're 2 or 3 deals in. You can actually start to keep that. But the ultimate aim is to then get to the point where you own enough properties outright that you don't need to do developments anymore. You can then pay back all those, no longer have the servicing that you're actually talking about, but you may keep it there for just in case of a rainy day or those sorts of things, mate. So yes, it does incur servicing costs, but we're talking typically residential rates in those instances. A couple of more people saying hi, so hello. Felicity says, be careful of your language. Your goal is to minimize your land tax, not avoid it. Avoid immediately suggests something dodgy. That's correct, Felicity, and I'll actually go into that a little bit further. The ATO actually has some very specific legislation that basically says you are allowed to minimize your tax, absolutely, but you are not allowed to avoid tax, okay? So, they have some pretty hefty scheme fines and penalties on avoiding tax. So, make sure that you're doing the best you can to minimize your tax, which you are allowed to do legally. So your accountant is the best person to actually give you the right advice on structuring in your particular state. Frank says, how do I find the private lenders? Frank, there's all sorts of private lenders, mate. There's high net worth individuals, there's syndicates of funds, there's people like your accountant or your solicitor who may be able to, I guess, pull some funds from some high net worth individuals. There's friends and family. I guess there's places like our development site Deal Hub where you can find investors all the time. Plus there are also development lenders who have high net worth individuals on their books that are more than happy to do private loans in there. So a mixed bag, Frank, but they're everywhere. Amy says, hi, Rob. Let's say we've just built a 6-pack and want to sell 5 and keep 1. In my experience, the tax is calculated based on the cost and revenue of each unit sold, not on the entire project. How do we transfer the profit from the 5 that are sold into the remaining unit? So I have to be really careful here, Amy. I'm not allowed to give legal or financial advice, so I can't give you specific. What I can say is, in my experience, you will have to pay GST on the 5 that you sell because you have actually paid those 5. You will be able to claim GST imputation credits against those 5, but you won't be able to claim them for the one that you've actually kept. And depending upon how long you keep it for, if you keep it for a minimum of 6 years, then it's likely to then incur capital gains tax, not GST. Again, make sure that you go and actually talk to your accountant about that and make sure that you're actually holding it in the correct entity right up front. One of the rules that I said tonight is understand your exit strategies. I said your development strategy, your acquisition strategy, and your exit strategy. If your exit strategy is to keep one, then the entity that you go into that particular project may be completely different to if you're intending to actually flip them. So make sure that you know that exit strategy once you're actually in there. Dean saying, watching lots of gold. Thank you, mate. Appreciate that. Arun is saying, great info as usual. Thank you, mate. Peter says, watch the webinar you did that started with the skydiving. How many jumps do you, mate? Peter, that's a little while ago. So that was back in October or November last year. I'm up to about 15 jumps with the skydiving. but COVID meant that we couldn't actually go up there for quite some time. So I'm well overdue for going back and somewhat rusty at this point in time. I'm not even sure if they've reopened the jump site, but I'm pretty sure they have, but haven't had a chance to go and look. But you've just given me a reminder to say I should go look. Harry's saying, getting DA doesn't increase value. I got a property with DA, I scrapped it. That's the point I was saying before, Harry, is to make sure up front that you understand your exit strategy and what is the next guy going to pay for it before you even go into it. Really, really key that you think about the exit in mind, and is the next guy going to make money? If they're not going to make money, it's probably not the right DA, which means that you're probably not in the right area. So they are all those rules are kind of intertwined. Fabiana says, hi Rob, question profit is not calculated per item. Let's say 4 subdivided lots. If you sell 2 this financial year and 1 next, the profit is not per lot and per financial year proportionally. Therefore, in the case that I'm not quite sure I understand the question, Fabiana. I will attempt to paraphrase what I think you're saying. Again, noting I can't give legal or financial advice. But effectively, you're saying that your project is actually run over several years. So there's 2 things. There's the profit of the project, and then there's also the turnover in the financial year, and they are different, okay? And if you're trading stock, as in you're intending to sell it, then your accountant may use a couple of different methods to actually determine whether or not they want to bring forward some of those costs into the previous financial year, or if they want to defer those into the next financial year. Accountants can do some pretty good wizardry with regards to, I guess, improving your cash flow and that sort of thing, in whether they bring costs forward or push them back into different financial years, depending upon whether or not they're treating those as trading stock or not. So make sure you go and talk to your accountant on that. But I guess the primary difference is the project profit versus the cash flow of any one particular year. So Liana says, in doing a smaller development, say 3 townhouses with 20% profit, would the preference be to sell 2 and keep 1, given that you still have positive cash flow, but it won't be fully owned outright? Liana, I can't give you, probably the 3rd time I've said it now, I can't give you financial advice here. What I would say as a guidance would be to say, how much is the residual debt that's actually left over? Is the property actually going to be positive cash flow enough? Is that going to impact your serviceability to go into the next deal? Or are you actually better to be pulling the cash out and actually have that as liquid cash that you can spend a lot easier? One of the things that we sometimes do, we're tempted to keep properties a little bit too early in the process, and we create an anchor around our neck because we create this glass ceiling and our borrowing capacity. And so, very hard to determine on that particular one you've just discussed there, but I'm going to say that's borderline as to whether or not you actually would want to sell that down or try to roll that over or keep it, for example. So JJ says, Rob, if it's a DA for a single dwelling, do you think there's a good chance of value? And if selling to an owner-occupier that plans to build, as you remove an element, one perceived element of risk for them, you prove the site is viable for a build. So JJ, in principle, what you're saying has validity. It always comes back to, I guess, the rule that I was saying before, which is my area profitable? Have you actually done the numbers on what is that finished house actually going to be worth at the very end? So what you're trying to sell it to them for. Then they add the cost to actually construct. What is the finished product actually worth at the end? You need to know what that finished product is. Whether you construct it or someone else constructed is not the point. The point is, what's it going to be worth at the end? Then you subtract the costs, then you subtract the finance costs as if you were running it all by yourself, and make sure that at the end of the process, there's actually a profit in the deal. Because if there's not, they won't necessarily take it on unless it's for an emotional sale and they're emotionally invested in it. So, you want to be very careful there that you're just not going in randomly trying to do sites like that in areas that are unproven. or don't mathematically work. Make sure that your area is going to be profitable, and then absolutely what you're saying has validity and merit. But make sure the numbers work. It's always about the numbers. K Wong says, hi Rob, your 7 rules of thumb didn't mention anything about consultants. Is it because the consultants that we use in development are less important? I feel that an architect is a more important consultant. No, mate, I go through, I guess, team members and that sort of thing on many other of my webinars. So I guess tonight was just some rules of thumb that many developers just don't consider, mate. So this was not about trying to belittle the fact that we need our consultants. They are absolutely required in the process, but this was trying to give you 7 rules of thumb that you may not have been considering. So I hope that helps. Charlene says, if you buy in an area you thought was a good deal, then the value of the home drops. Is there any hope of making a profit if you get a BA and put an auxiliary dwelling on it? This is kind of repeating the same information, Charlene. We can never predict market movements, whether they be up or down. It's like trying to read from a crystal ball. But what we should do is stress test our deal. So we know where we're anticipating the sales to actually be. We should be able to stress test that and say, well, if the market drops 5%, where do I think it's going to actually happen? If it drops 10%, what do I think I'm going to do? If it drops 15, what am I going to do? So you want to make sure that you actually stress test that and know exactly what happens and which lever gets pulled as the market actually starts to drop. So without having done that particular assessment for your particular deal, I can't tell you if it's a 5% drop or a 15% drop before that would start to trigger. However, I make sure, per my, I guess, first set of rules, make sure that you actually understand your acquisition, your development, and your exit strategy. And that exit strategy, right up front, you should be analyzing what's the finished product worth and how do I actually stress test it. Amy says, wonderful, thanks, makes a lot of sense. You're more than welcome. Rajiv says, excuse me for asking silly questions to follow this just now. What is a DA mean? DA is shorthand for development approval. In some states that might be called plans and permits, depending upon where you're actually based, Rajiv. Hope that helps. And Sean says, previously always found a bit of confusion in the terms on the first pages, GRV, profits, etc. Thanks heaps for clarifying that. Great session as always. Thank you. More than welcome, Sean. Glad you got plenty out of it. And given that there are no more questions, I'm going to say thank you all, folks. Appreciate you coming here yet again for another Sunday session. Look forward to seeing you again next Sunday when we do this all again. And in the meantime, make sure you join our Facebook groups. Make sure that you, I guess, come to our meetups and hang around people in your community. And we would love to see you at our next event. Till then, bye for now, folks. See ya.